Professor Ernstberger, your academic focus is on financial reporting and its relationship with managerial behavior. Just give me a little bit of background why you are interested as an academic scholar to look into that topic.
So we are particularly looking into quarterly reporting, and there has been a discussion for more than 10 years on this topic. So we had on the pros and cons of quarterly reporting. So for example, in Germany, we had the example of Porsche that refused to issue quarterly reports just because they say that it increases quarterly managerial myopia, and so they even accepted not to be included in the MDAX, a prestigious stock segment in Germany, and just not to issue quarterly reports. There were also some discussions in the US now recently in the campaign by Hillary Clinton that said that corporate America is quite obsessed with quarterly capitalism, and well, the main battleground, let's put it like that, of whether you should have quarterly reporting or not is in the European Union, in the EU, because they first issued a transparency directive that was a kind of compromise, because there they wanted to have quarterly reporting, but not the full quarterly reports, just interim management statement. So that's a short explanation of the financial position of the firm and the performance in the quarter. But afterwards, they took a roll back in 2013 and abolished that again. And one major reason for that was that it may create managerial myopia. So this is what we wanted to focus in our research here. Mm-hmm. And we also have some discussions in research. So quarterly reporting increases transparency, increases the monitoring of managers, but on the other hand, it may have costs, direct costs in terms of preparation, in terms of dissemination of the reports, but also this indirect costs we wanted to have a look at in terms of managerial myopia.
Mm-hmm. Just give me the rough picture on your methodology. What was sort of the data you collected there, and how have you collected it?
Uh-huh. So we compiled actually a data set on the European Union, because in the European Union we historically had some countries, for example in Portugal or in Greece, that had already quarterly reporting in place for all the time. And we have had other countries that had to implement it with this transparency directive I just mentioned. And so we compiled, what country had had which regulation on quarterly reporting. And then we did quite something like a clinical trial. So we had a control group of firms that already had quarterly reporting in place, and we had a treatment group that had to implement that. And then we had a look at real activity manipulation, which is a kind of measure for this managerial behavior. So we have a look at whether managers indeed cut or postpone, for example, research and development costs or advertising costs or maintenance, just to hit benchmarks, for example, analysts' expectations or investor expectations.
Which leads us to the direct findings of the study, which is, at the broad picture, if I understand it correctly, quarterly reporting tends to increase short-termism in managerial behavior. But perhaps you can give us some examples of stemming from your findings, how managers actually behave in these situations.
Mm-hmm. So first of all, we were quite surprised by the magnitude of the effect. So it was 3.1% of total assets increase in this real activity manipulation we have found in our research there. And so we took a closer look at what are maybe driving factors of that. That was the first point, and we find that, for example, it's the pressure of investors on managers That's a driving factor. So we measured that by the importance of the capital market or by the myopia of investors. So investors also tend to have a different degree of myopia, and we try to measure that by their strength or focus on short-term results. That was the first thing. The second thing was we focused on the informativeness of this interim management statements. So we actually collected more than 5,000 of these interim management statements and had a look at the content. And this was also a very, very important finding that the more transparent these interim management statements or quarterly reports are, the lower is the effect. So investors are able to uncover then the effect of quarterly reporting or this managerial myopia, and so managers anticipate that and avoid this behavior.
There's a broad literature, academic literature out on that subject already. What would you say you've sort of put as an edge on top of that in terms of your methodology, in terms of your approach to analyzing that topic?
Mm-hmm. So there was already an analytical study showing that this effect might occur, but actually, and we were surprised also about that, we were the first to empirically show this effect on a real capital market. And this is the first thing. Second thing is about these driving factors. So I think it's quite important for regulators and also for companies to know what are driving factors and how can I avoid this effects in the future, or how can I regulate the market to avoid this effect. And well, finally, it's also about the magnitude of the effect. And we also had a look at the operating performance after really managers try to hit benchmarks, and we find that in the long term we have a lower operating performance. So this is maybe driven, for example, by a short-term decrease in research and development, which helps in the short term to increase results, but is detrimental to long-term performance.